Hello and welcome to Intelligent Investment Today, the podcast dedicated to the art of value investment as inspired by Benjamin Graham. In this episode, we turn our attention to one of the most successful and widely admired investors of the modern era. A fund manager whose approach combined common sense, curiosity, patience, and an extraordinary ability to identify growing businesses before Wall Street fully appreciated them. Today we're going to be talking about Peter Lynch. And more specifically, we're going to explore an interesting question. Was Peter Lynch actually a value investor? Now at first glance, the answer may seem obvious. Most people associate Lynch with growth investing. After all, he famously invested in rapidly expanding companies and achieved remarkable returns while managing the Fidelity Magellan Fund. But the deeper you look into his philosophy, the more nuanced the answer becomes. Because while Lynch certainly embraced growth, many of his underlying principles align closely with value investing. So today we're going to examine how Peter Lynch approached investing, what made him different, and whether the label value investor truly applies. So let's get right down to it. As always, sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. So let's start with the very basics. Peter Lynch became famous for his management of the Fidelity Magellan Fund between 1977 and 1990. During that period, the fund produced extraordinary returns and significantly outperformed the broader market. But what made Lynch particularly interesting was not just the performance, it was the accessibility of his thinking. Unlike some investors who relied heavily on complex models or macroeconomic forecasting, Lynch often spoke in very straightforward terms. He encouraged investors to look at the world around them, to observe products, retail stores, consumer behaviour. He famously promoted the idea of buy what you know. And this is one reason his investing philosophy resonated with so many ordinary investors. It felt understandable, practical, grounded in observation rather than abstraction. Now at first glance, this may not sound particularly connected to traditional value investing. After all, when people think of value investing, they often think of low price to earnings ratios, discounts to book value, deeply undervalued companies. The influence of Benjamin Graham. And Lynch was not strictly operating in that world. He was willing to buy growing businesses, companies expanding rapidly, businesses with strong future potential. In some cases, he paid valuations that more traditional value investors might have considered too high. So does that mean he was not a value investor? Well, not necessarily. Because value investing, at its core, is not simply about buying cheap stocks. It is about buying businesses for less than they're worth. And that worth includes future earnings power. This is where Peter Lynch becomes more interesting. Because while he embraced growth, he remained deeply focused on valuation. One of Lynch's most famous concepts was the PEG ratio. Price to earnings relative to growth. The idea was simple. A company growing earnings rapidly may deserve a higher valuation. And therefore, he thought that looking only at the price to earnings ratio in isolation can be misleading. For example, a company trading at 20 times earnings may appear expensive. But if earnings are growing at 20% per year, that valuation may actually be reasonable. This is a critical distinction, because Lynch was not blindly chasing growth. He was evaluating growth in relation to price. and that is fundamentally a value-orientated idea. He wanted growth, but he wanted sensible growth at sensible valuations. In many ways, this places him somewhere between traditional value investing and pure growth investing. He was not buying speculative businesses with no earnings, nor was he limiting himself to only statistical cheap companies. Instead, he was searching for situations where the market had underestimated future potential. And that, in essence, is a form of value investing. Another important aspect of Lynch's philosophy was simplicity. He preferred businesses he could understand. Companies with straightforward products and understandable economics. This idea overlaps strongly with investors like Warren Buffett, who frequently emphasize investing within one's own circle of competence. Lynch thought that investors often overlooked simple businesses because they seemed unexciting, and yet those businesses could become exceptional investments. A regional retailer, a restaurant chain, a consumer brand. These were often far easier to analyse than highly technical industries. And importantly, they could possess strong long-term growth opportunities. This again connects to value investing principles, because simplicity reduces uncertainty. The easier a business is to understand, the easier it becomes to estimate its future earnings power and intrinsic value. Now, Lynch was also highly sceptical of excessive macroeconomic forecasting. He often argued that investors spent far too much time worrying about interest rates, recessions, or geopolitical events. Not because those things were irrelevant, but because they were very difficult to predict consistently. Instead, he preferred focusing on individual businesses, their products, their growth, their competitive position. And this bottom-up approach aligns strongly with the mindset of many value investors. Because ultimately, long-term returns tend to be driven by business performance more than short-term macroeconomic headlines. However, there are also clear differences between Lynch and more traditional value investors. Benjamin Graham often focused heavily on downside protection, on balance sheets, asset values, margins of safety based on tangible numbers. Lynch, by contrast, was more willing to embrace uncertainty if he believed the growth opportunity justified it. He was comfortable owning companies that were expanding aggressively, businesses whose future value depended heavily on execution. And this naturally introduces greater risk, because growth projections can disappoint. Competition can emerge, industries can change. So while Lynch remained valuation conscious, he was operating with a greater emphasis on future potential than classical Graham-style investing. This is perhaps why some investors classify him as a growth at a reasonable price investor, often abbreviated to GARP or GARP. This form of investment is a middle ground between value and growth. And honestly, that description fits Lynch quite well. Now, another defining characteristic of Peter Lynch was his willingness to do extensive research. He did not simply screen for numbers. He studied businesses deeply. He visited stores, observed customer behaviour, spoke to management. He looked for evidence that a company's success was real and sustainable. And importantly, he categorised companies differently depending on their characteristics. Slow growers, fast growers, turnarounds, asset plays. Each category required a different mindset and valuation approach. This is important because it highlights Lynch's flexibility. He was not rigidly attached to one formula. He adapted his analysis to the nature of the business. And that flexibility is often a feature of great investors. Because markets are complex. Different businesses create value in different ways. And successful investing often requires a nuance rather than strict ideology. So let's now return to the central question. Was Peter Lynch a value investor? The answer, perhaps unsurprisingly, is both yes and no. If by value investing we mean buying statistically cheap companies, trading below liquidation value, then no, Lynch was not primarily operating in that tradition. But if we define value investing more broadly, as buying businesses for less than their intrinsic worth, then absolutely. Because Lynch cared deeply about valuation. He cared about avoiding overpaying. And he searched relentlessly for situations where the market had underestimated future growth and earnings potential. In that sense, his philosophy sits comfortably within the broader world of intelligent investing. He simply approached value differently, not through cigar butt investing or distressed assets, but through identifying quality growth businesses before the market had fully recognised them. And this is perhaps one of the most important lessons investors can learn from him. Value investing is not one rigid formula. It is a framework, a way of thinking about price and value. And within that framework, there is room for different approaches. As we begin to draw this discussion to a close, it's worth reflecting on why Peter Lynch remains so influential today. Partly, of course, it is because of his performance. But perhaps more importantly, it is because his philosophy feels accessible. He reminded investors that successful investing does not always require predicting economies or analysing complex technologies. Sometimes the best opportunities are found in ordinary businesses, hiding in plain sight. Businesses with understandable products, strong growth, and valuations that still make sense. And perhaps that is where Lynch bridges the gap between value and growth investing so effectively. He recognised that growth creates value, but only if the price paid remains reasonable. That brings us to the end of today's episode. A look at Peter Lynch, his investing philosophy, and the question of whether he truly belongs in the value investing tradition. Perhaps the most accurate answer is this. He was not a traditional value investor, but he was absolutely an intelligent investor. And in the end, that distinction may matter far more. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay patient, stay curious, and most of all, stay safe.